Imagine a world where the ability to predict the future could make you rich. A world where traders, merchants, and even philosophers placed bets, not just on goods, but on time itself. This world is not new. In fact, it's over 2,500 years old. This is the story of options trading, one of the most powerful and often misunderstood tools in financial history. Welcome to the Trade Savvy Academy. Our journey begins in ancient Greece with a man named Thales of Miletus. Thales wasn't a merchant or a farmer. Many dismissed him as an impractical thinker because he wasn't born wealthy. But Thales possessed something even more valuable than wealth: knowledge. By studying the movements of the stars and analyzing seasonal patterns, Thales made a bold prediction. The upcoming olive harvest would be exceptional. Instead of buying land or labor, Thales secured contracts with local olive press owners, paying a small fee to lock in the right, but not the obligation to use their presses at a fixed price during harvest season. When his prediction came true and the demand for olive presses surged, Thales sold his contracts at a premium. He walked away with a fortune without ever owning a single olive tree. His strategy wasn't just clever, it was revolutionary. Thales' story is often regarded as the first recorded options trade, demonstrating how a deep understanding of the future could be turned into wealth. Options in the Roman Empire: managing risk in an expanding world. The brilliance of Thales' strategy didn't end in Greece. The Roman Empire, known for its vast trade networks and economic ingenuity, adopted and expanded on similar practices. In the bustling forums of Rome, merchants and traders developed contracts to manage uncertainty in markets that spanned thousands of miles. These contracts allowed farmers to hedge against poor harvests by locking in a price for their crops ahead of time. Meanwhile, traders used these agreements to manage risk when shipping goods across the Mediterranean, where storms and pirates often disrupted trade routes. While these contracts lacked the complexity of modern options, they set the foundation for managing financial risk in unpredictable markets. Not everyone approved of these practices, however. Even in Rome, debates about speculation and fairness arose, foreshadowing the ethical dilemmas that continue to surround financial markets today. The first speculative bubble: Tulip Mania in the Netherlands. In the 1600s, the Dutch Republic was the economic powerhouse of Europe, driven by its vast trade empire and innovative financial markets. But among their most famous and infamous ventures was the trading of tulip bulbs. Tulips, imported from the Ottoman Empire, became a symbol of wealth and status. Rare tulip bulbs fetched astronomical prices, with some costing more than the finest homes in Amsterdam. Traders began using options contracts to speculate on future tulip prices, hoping to profit a demand soared. At the height of tulip mania, fortunes were made seemingly overnight. But when the bubble burst, chaos ensued. Tulip prices plummeted, leaving countless traders bankrupt and sparking one of history's first speculative market crashes. The lesson was clear. Speculation can lead to incredible rewards, but unchecked greed often results in disaster, a pattern repeated throughout financial history. The birth of modern financial markets. By the 1700s, financial markets were evolving rapidly. London emerged as a hub for global trade and finance, attracting merchants, bankers, and investors from around the world. Here, the concept of options trading took on new forms. Early stock traders began making agreements to buy and sell securities at specific prices in the future. But with limited regulation, these markets were often riddled with fraud and manipulation. During the infamous South Sea bubble, speculative frenzy drove stock prices to unsustainable heights before a dramatic collapse, ruining thousands of investors. Fearing the dangers of speculation, the British government banned options trading for decades. Yet despite these setbacks, the demand for these financial tools persisted. The American frontier: Wall Street's early options markets. Meanwhile, across the Atlantic, America was forging its own financial markets. In the late 1800s, options trading gained traction on Wall Street, often through informal and unregulated markets. These early options markets were risky and often resembled gambling more than investing. Unsuspecting traders fell victim to schemes and manipulation, highlighting the need for standardized contracts and regulated exchanges. A revolution in finance, the CBOE and Black-Scholes. By the 20th century, the need for regulation and transparency led to the creation of the Chicago Board Options Exchange. In 1973, the world's first regulated options market. For the first time, traders could access standardized contracts with clear rules, ushering in a new era of financial innovation. That same year, the Black-Scholes model revolutionized options pricing. By introducing a mathematical framework to calculate the fair value of options, this model brought a level of precision and accessibility that transformed options trading into a mainstream financial tool. The digital era and retail access. The rise of computers in the 1980s and 90s brought unprecedented speed and complexity to options trading. Sophisticated algorithms allowed institutional investors to analyze vast amounts of data and execute trades in milliseconds. By the late 1990s, online platforms like E-Trade brought options trading to the masses. For the first time, individual investors could participate in markets once reserved for institutions, leveling the playing field. But as history has shown, financial power comes with financial risk. During the 2008 financial crisis, options and other derivatives played a controversial role. Some used them to hedge against losses, while others suffered catastrophic collapses. The crisis led to stricter regulations, but it also reinforced the importance of understanding how options work. The present and future, AI and beyond. Today, we stand at the cutting edge of financial technology. Artificial intelligence and machine learning are transforming options trading, allowing traders to predict market movements with incredible accuracy. Automation has made trading faster and more efficient, but also more competitive. As these tools become more sophisticated, the line between human and machine-driven decision-making continues to blur. The future of options trading promises both incredible potential and new challenges. Closing thoughts. From the olive presses of ancient Greece to the algorithmic trading systems of today, the history of options trading is a testament to human ingenuity and the pursuit of financial growth. Yet with great power comes great responsibility. If you enjoyed this journey through time, don't forget to like, subscribe, and hit that notification bell for more fascinating financial stories and educational content. Because history has a way of repeating itself, and the best traders are the ones who learn from the past. The Trade Savvy Academy wishes you all the best in your options trading journey.